Hello guys and welcome again to my channel. So it's been a very long time since my last upload. So if I can still remember, we have talked about the accounting for service entities, right? So today we're going to talk about the accounting for merchandising entities. Now, before we start, of course, there are a lot of differences between the accounting for service entities and the accounting for merchandise entities. Of course, I could name you at least 9 differences. And we're going to talk about the number one key difference on the accounting for the merchandising entities. Okay? Now, before we start, of course, you can subscribe, click like, and then share this video if you have learned already in my past videos and if you think that you are learning all throughout this video. Now, if you are not used to how slow am I talking, because actually English is not my primary language, you can go to the settings of your YouTube application and then you have to choose times 1.25 times 1.5 and etc. And if it is still difficult to understand, you can have the subtitles or the captions on your YouTube application. It is like CC, something like that. You have to click on it and subtitles will be available to you. Okay? Now, let's start. So, merchandising entities. The number one difference of merchandising entities with the service entities is, of course, the transactions, buying, and selling. Because this is not present in service entities. In merchandising, the merchandising business is actually buying some finished goods. And after buying that finished goods, you are going to put a markup and then you're going to sell it. Of course, again, let me repeat, it's not present. These transactions are not present with service entities because you are just selling your services as it is. Okay? So, this is the first one and this is a major one. Okay? Now, let's start on the buying part. On the buying part, our point of view is a purchaser. So, for example, when we talk about a normal purchase transaction, for example, purchase, the entry, which is here in the merchandising entities, which is absent in the service entities, is debit, purchases, credit, cash. If you're going to purchase it for cash. But usually, purchases of corporations and other companies are usually made on account. So, the secondary, aside from cash, the secondary account that will be used is the accounts payable. So for example, a business purchased finished goods worth 3 million. This would be the normal or regular entry. Purchases 3 million, cash or accounts payable 3 million. Let's stick with accounts payable. Okay? So that's the normal entry for purchasing. However, this is not as easy as it is. It is because I have still some twists later related to being a purchaser. However, before we go to that, let's talk about these accounts. Of course, you know the account title cash already. That is an asset, right? And the accounts payable is, of course, a liability account, a current liability account, if you can still remember. The question is, what is this account? Purchases. As early as this particular video is concerned, and if you only have, as if we're going to treat that you have only seen accounting videos of mine, past videos for service entities, and you don't know anything yet, like zero base, these purchases, you have to treat this as an expense. Okay? So the more the purchases is, the lesser the net income. The same with expenses. The more the expenses, the lesser the net income. Are we clear on that? Because actually, it's logical. When you purchase, of course, that's a bad thing if ever you have purchased and then it will not be sold because there are no people who will buy it. So meaning, purchases is really somewhat like an expense. Okay? So, treat this as an expense and it usually is a deduction for the net income. So that's purchases. Now let's go to the twists. The twists for this one is that we have purchase discount. Purchase discounts. So that's the first twist. What is that? What is that purchase discounts? So in merchandising, we have two types of discounts. The two types of discounts are trade discounts. Example of the trade discounts is buy one, take one. But the trade discount is actually like this. When you buy five, you get a discount of 10%. 5 items, you get 10%. That is the example of a trade discount. Okay? So, basically, this first type of discount encourages the customers to buy more instead of buying less. Okay? So, that is trade discount. The second type of discount is what do we call as the cash discount. So, normally, the cash discount is something like this. 310 and 30. So, what does it mean? When you are the purchaser and you have purchased on account, if you can see this type of terms, this is usually called credit terms. The meaning of this one is that if you pay within 10 days, you will enjoy a discount of 3%. So that is a cash discount. So as you can see, they are very much different because the cash discount encourages prompt payments of the customers. And in our case, since we are the purchaser still, it encourages us to pay earlier. Okay? So trade discounts, it encourages us to buy more. Cash discount encourages us to buy, cash discounts encourages us to pay promptly. Okay, so that is the difference between the two. So how is it related to this one? The purchase discounts that are usually recorded as purchase, the discount which is usually regarded as a purchase discount is this one. The trade discount, there are no entries in that. It is because if you avail for the trade discounts, this 3 million right here is already considered as net of discount. So there is no separate entry for trade discounts. So again, the trade discounts, there will be no entry. There will be no effect on the buying entries of the merchandising entity. It's because it is assumed that when you purchase for this one, 3 million and 3 million, it is as if already netted with trade discounts already. Okay? So meaning, my point is, there is only an additional entry if ever we're talking about cash discounts. Okay? But for example, you have paid within 10 days. So you will have 10% discount. So how much is 10% of 3 million? 10%. 3% of 3 million. Wait. I don't know how to solve this mentally. Bear with me, guys. I'm the only one here. So we have 3 million times 0.03. So that's about 90,000. So that means you are going to enjoy 90,000 discount when you pay within the discount period. And this will be the entry. Debit. Of course, your accounts payable will be closed out, the whole 3 million. And then, you're going to credit cash, but this time, your cash that you're going to pay is not 3 million. It's only 2,990,000. Okay? 2,990,000. It is because, am I right? 2,910,000. Even now, I'm not still sure. It's 2,910,000. Okay? Because there is a purchase discount of 90,000. Because you have paid within the discount period. This 10 days is what do we call as discount period. Okay? So let's summarize again. When we have purchase discounts, you do not confuse the purchase discounts with trade discounts. Purchase discounts are not usually, purchase discounts, it means cash discounts. Just like this. That encourages prompt payment. And this will be the result if ever you're going to enjoy purchase discounts. So you have your accounts payable. It's fully settled 100%, 3 million. But you have only sacrificed 2,910,000 because you have enjoyed purchase discounts. Okay? Now, if you're going to be asked, how much is the net purchases? Net purchases or the amount that you're going to pay in the future if it is on account, or the amount that you have paid effectively if you have purchased based on cash. The answer is 3 million minus 90,000. So that's 2,910,000. Because your purchases, this is considered as the gross purchases. So before any deductions, before the purchase discounts. So 3 million minus the purchase discount of 90,000, and you will have 2,910,000 as the net purchases. Okay? So basically, even if they are similar in name, as you can see, and they are netted as to each other, they have different effects. The purchases are somewhat like the expenses, in which if there are more purchases, if there are more expenses, the net income will go down. Whereas this purchase discount, the more purchase discounts that you enjoy, the net income will increase. Okay? Which is why this is debit here. The normal balance of purchases is debit, and the purchases discount is credit. Okay? So that's one of the twists in the buying. Okay? Next, we have purchase, returns, and allowances. So this is the next one. So the purchase, returns, and allowances happens if ever you return some items. So why do you return some items? There are basically two reasons. The first one, what you have received from your supplier are damaged goods. Okay, so that's the first one, the most common one. So you're going to return it. Okay, and the second one is, even if you have received good items, however, the brand is not the same with what you have agreed upon with the supplier, or else the description does not fit on what you want, on what you have agreed, like color or size or something like that, and other specifications, of course, you have to return it. Okay? So what will be your entry if you return something? Of course, your accounts payable will be decreased, so it will be debited. Like for example, you returned 200,000 worth of goods. So accounts payable 200,000. And then credit, purchase, returns, and allowances. Just like that. Okay? So meaning, the purchase, returns, and allowances, it's somewhat like the purchase discount. So the more the purchase discount, the more the purchase, returns, and allowances, the higher will be the net income, because these two are deducted from the purchases. So actually, if you're going to be asked, how much is the net purchases? You have the gross purchases, of course, minus the purchase discounts, and minus the purchase, returns, and allowances. Okay? And going further, we have the other one. Last, so we have freight in. Okay? So that's the last twist here. But it's a little bit complicated, this freight in. So this freight in, freight, that's the spelling, freight, or transportation in, is the missing link in order to compute net purchases. Because what will happen is that if you are going to be asked how much is the net purchases, of course, you have gross purchases, minus purchase discounts, minus purchase, returns, and allowances. But you have to add transportation in or freight in. Okay? So it's included in your purchases. Why? Because it's related to your purchases. Actually, this transportation in are the costs that you have paid for so that the inventories from your supplier will be transported to your company's premises or the location where you want those inventories to be displayed. Okay? So meaning, if you are buying some merchandise inventories from factories or from suppliers, so from that factory or from that supplier, the labor cost that that is incurred by you by transporting those goods from your supplier or factory until your store, those are considered as transportation in. And if you hired a carrier, I don't truck, for example, because you have a lot of inventories bought from your supplier, the cost of the truck, renting the truck from the company's premises of your supplier towards your company's premises, those are to be recorded as freight in or transportation in. And usually, the freight in or transportation in the entry is freight in, depending on the chart of accounts of your company. Freight in, for example, you have incurred 50,000, freight in 50,000, and then credit cash 50,000. So that's it. That's the missing element if you compute for net purchases. And it is to be added because as you can see, it's debit here and it's debit also here. Because actually, you don't only compute for the cost of the inventories that you have paid for from your supplier. You have also to include there the cost of transporting, which is logical, right? Which is why this is included in the computation of the net purchases. Okay? Easy, right? However, there are twists in this. So, if you wanted to copy this, you can pause. And after pausing, you have to listen to me on the freight in. Why? Normally, this is the entry. This is the entry if we're talking about terms like free on board, FOB, free on board, FOB, shipping point, freight, collect. There are two terms here. So that will be your entry. If ever, FOB shipping point and freight collect. Okay? So, the FOB shipping point has a counterpart, FOB destination, and the freight collect has a counterpart. That is what we call as freight prepaid. So what does this mean? FOB shipping point, it means to say, there are two meanings of this one. The first is the owner of goods in transit. In transit, that means it's not already in the premises of your supplier, but it did not yet arrive also in your company's premises in transit. Okay? The owner of the goods in transit is the buyer. So that's the meaning of that. So meaning if you can see FOB shipping point as credit term, that means the owner of the goods in transit is the buyer. So that's the meaning of that. This is the technical term. This is the understandable definition. Okay? And another meaning of that one is that the buyer is supposed to pay for freight or transportation. So those are the two meanings of the FOB shipping point. And you have to remember that. Okay? Again, what's the meaning of FOB shipping point? The owner of the goods in transit is the buyer. Of course, the buyer is supposed to pay for the freight. Of course, because he's the owner of the goods in transit. Alright? Now, How about the freight collect, sir? The freight collect, that means the buyer actually paid the freight. So that's the meaning of those. FOB shipping point, the owner of the goods in transit is the buyer. And of course, the ones that is responsible for paying the freight is the buyer. And freight collect is the buyer actually paid the freight. That's the meaning of those technical terms. Of course, it could be the opposite. So the opposite is FOB, destination, which meant the owner of the goods in transit is still the seller, and the seller is supposed to pay the freight. That's the meaning of FOB, destination. Okay? So in order for you to remember it more easily, you have to remember FOB shipping point, the title passes upon shipment. So that means since the goods that we're talking about here are in transit, meaning it has already been shipped, then the owner from seller, it becomes the buyer already upon shipment. So the goods in transit are owned by the buyer. FOB shipping point, the title passes upon shipment. But if we're talking about FOB destination, the title passes upon reaching the destination. So that means it will be owned only by the buyer, these goods that are in transit, if it arrives to the company's premises of the buyer. So when in transit, it is still owned by the seller. So that's it. Okay? And of course, freight prepaid is the counterpart of freight collect. Freight prepaid meant or means the seller actually paid for the freight. What does it mean? Like, for example, if we take a look at freight collect, that means the freight is being paid after it has been collected by the buyer. So that's freight collect. Freight prepaid, from the word prepaid, before the goods are shipped, they are already paid. By who? The seller, of course. Did you get it? So meaning, of course, if the freight, before it was shipped, no. If the goods or the inventory's freight has been paid before it has been shipped, of course, the seller actually paid for it. So that is what we call as freight prepaid. Okay? So, those are the meanings of those. And of course, let me repeat, this particular entry will only happen if ever the conditions is FOB shipping point freight collect. We are the buyer, so that means we're the owner of goods in transit and we are supposed to pay for the freight, which is why we recognize freight in. Because you only put freight in or transportation in if you are supposed to pay as the buyer. Okay? So freight in. And then credit cash because we are the actually ones who paid because our point of view here is the buyer. Do you understand? Okay. Now, are there any combinations of this four? Yes, of course. It could be FOB, shipping point. We are the buyer, so we are supposed to pay. FOB shipping point. Freight, prepaid. So, we are supposed to pay, buyer, and we are the owner, freight prepaid. Who paid actually? Of course, the seller actually paid. So what will happen if it's like that? If it's like that, since we are the ones obligated to pay for the freight, because we are the owners, we are still to recognize an account freight in 50,000. But then, we cannot credit cash because it's not freight collect. We are not the ones who paid for it. Instead, the seller. Right? So what will happen is, your accounts payable will increase. So that's the entry. If ever you are the buyer And of course, the shipping terms are FOB shipping point and freight prepaid. It's logical. It is because this is your obligation and you let the seller pay, actually pay. So what will happen is that you will have freight in. However, your obligation to the supplier will become greater also because your obligation, you did not pay for your obligation. You let the seller pay for your obligation. Okay? Of course, we could also have the FOB destination. So who's the owner? Seller. And we are the buyer here. So seller is supposed to pay for the shipping fee or the freight or the transportation, right? FOB destination freight collect. So what is the meaning of that? The actual payment was made by you as the buyer. So what will happen if it's like that? Of course, since the obligation to pay for the freight is not yours, you're not going to put any freight in. Again, you're only going to enter freight in if you are the owner of the goods in transit and you are obligated to pay for the freight. Okay? So what will happen? Of course, since it's not your obligation and you are the one shouldering it, actually paying for the transportation in, what will happen is that your accounts payable will be lessened. Like for example, 50,000. It will be debited. And then credit, cash. Because again, it's not your obligation. So it's the obligation of the seller and you have paid for it. Of course, your liability from the supplier will be lessened, but you are going to pay for cash because it's freight collect. Something like that. Okay? Now, if FOB destination, freight prepaid, that means the obligation to pay for the freight rests with the shoulders of the seller and they actually paid also because we're talking about freight prepaid. The seller actually paid for the freight. Then you will have no entry because it's their obligation and they paid for it and you are the buyer. Of course, you will not have any entry. Do you follow? So again, this is the usual freight in, credit, cash. If FOB, shipping point, freight collect, you are the ones obligated to pay for the freight and you are the ones who actually paid for the freight. So freight in, credit, cash. So actually that is the default. So meaning if ever there are problems and the credit terms is silent, this is your default. Unless it's mentioned otherwise. Okay? So I guess that's it for this video. Let's talk about the selling part. Our point of view after purchasing is we are going to sell it at a markup. So let's talk about that on the next episode. Okay? Thank you. So if you did, again, if you learned, please click like, subscribe, and hit the notification bell and share this video to those who need it. You can comment so that I'll be able to see it and I'll be able to understand if ever you have learned or if you have requests, I can maybe consider it on the next episode. So thank you for watching and see you on the next one.